Disclaimer.
It's AG. I just celebrated my 100th video, but the market continues to panic, so there's no time for fun. It's time to reveal the latest analyses. Silver just spiked 17% overnight. After the single most violent crash in 45 years, the market is screaming back to life. But is this a real recovery, or are you being lured into the ultimate trap? While the mainstream media is calling this volatile, the legendary Robert Kiyosaki just went on the record with a message that changes everything. He's calling this crash a mega sale, not a sell-off. Why? Because while the price was being manipulated down to $72, the US debt just crossed $36 trillion, and the industrial demand for AI and solar hasn't moved an inch. But here's what they aren't telling you. This 17% bounce happened exactly as JPMorgan and the big banks needed to cover their massive short positions. Is this a genuine bottom fueled by smart money, or a calculated maneuver to shake you out before the real moon mission begins? Today, we are diving into the data the banks want to hide. The $19 billion freeze at JieWoRui, the margin hikes that failed to kill the bull, and the one reason Kiyosaki says the fake price is about to collide with a very real physical shortage. The paper market is breaking. The physical reality is taking over. Let's find out if this is the bottom or the last chance to get in before the door locks forever. Let's get into it. Picture what happened during that December chaos. Silver crashed from $122 to $71, a 40% wipeout that destroyed retail positions and pension fund holdings. But while your paper silver evaporated, something extraordinary was unfolding across Asia. In Shanghai, physical silver dealers were charging 95% premiums over spot price. Chinese buyers were paying almost double the crashed paper price just to hold actual metal. In Tokyo, premiums hit $130 per ounce. In Singapore and Sydney, queues formed outside bullion dealers as inventory vanished. Then, the smoking gun emerged. JieWoRui, one of China's largest precious metals trading platforms with 4 million users, froze $19 billion in customer assets. The official explanation cited market volatility, but reports surfacing from Guangdong province reveal the truth. According to sources familiar with platform operations, JieWoRui was caught in a naked short squeeze when their physical suppliers got hit by China's export ban on strategic metals. They had sold silver to millions of customers but had zero actual metal to deliver when those customers demanded physical possession. This isn't a platform failure. This is proof that paper silver markets were operating on pure fantasy, selling metal that didn't exist until physical demand exposed the fraud. This creates a puzzle every American investor needs to understand. How can the same asset crash 40% in paper markets while people stand in line paying massive premiums for the physical version? It's like watching gasoline prices collapse at futures exchanges while your local gas station runs out of fuel and charges triple. The official story reported routine market correction driven by investor sentiment. But Federal Reserve discount window data tells a different story. An unnamed bank received $17 billion in emergency cash on December 26th. That same week, the Chicago Mercantile Exchange doubled margin requirements for silver futures contracts in 48 hours. For those unfamiliar with futures mechanics, this is the financial equivalent of your mortgage lender suddenly demanding you double your down payment overnight. Traders holding silver positions were forced to inject massive capital or liquidate immediately. According to commodities analysts at Goering and Rosenzweig, this sequence matches the signature of forced liquidation to prevent bank insolvency from trapped short positions. When you are betting silver will fall and the price instead rises to $122 per ounce, your losses become catastrophic. Banks face a choice. Cover those shorts by buying physical at devastating losses, or manipulate paper markets to crash the price and escape. Kevin Warsh's Fed chair nomination provided the perfect cover. His first unofficial comment hinted at monetary stability in a way that shocked institutional desks. The market interpreted those words as potential return to a gold or commodity-backed monetary framework, something not seriously discussed in our country since 1971. Within hours, silver snapped back 17% as banks scrambled to exit shorts before a policy shift could trap them permanently. This wasn't about interest rates. This was about banks realizing they might be holding losing bets against commodities in a world where the Fed chair wants those commodities backing our currency. The paper versus physical disconnect became impossible to ignore. While silver crashed on COMEX futures exchanges in New York and Chicago, physical dealers in Singapore pulled inventory from sale. Australian mints reported their largest order backlog in company history. The Perth Mint announced delivery delays of 8 to 12 weeks for coins and bars. And here's the kicker that should concern every American investor. The United States Mint had just reported complete depletion of Type 2 Silver Eagle blanks for February production. Even as the price bounces back 17% on your screen, you literally cannot buy a new Silver Eagle coin from the source that produces them for our government. If silver was genuinely collapsing due to weak demand, why would our own mint run out of inventory? According to the World Gold Council's quarterly precious metals report, this represents the largest paper-physical decoupling ever recorded. The spread between paper prices and physical premiums reached levels that make 2008's financial crisis look tame. During the Lehman Brothers collapse, physical gold premiums hit 15 to 20% above spot. This silver disconnect exceeded 95% in major Asian markets while paper crashed. Imagine checking exchange rates for a Europe vacation. The official dollar-euro rate shows 1-to-1, but the currency exchange charges you $2 per euro. Claiming high demand and limited supply, you'd immediately recognize something broken in the system. That's exactly what happened in silver markets during December. The manipulation becomes obvious when you examine who was on the other side of these trades. While retail investors and pension funds watched silver collapse, certain institutional players made very different moves. COMEX delivery data for January 2026 shows record amounts of physical silver being claimed from exchange warehouses. Someone with inside knowledge was using the paper crash to acquire massive physical metal at bargain prices. They crashed the paper market through futures manipulation, then stepped in to claim actual silver while prices were artificially suppressed. According to Bank for International Settlements data, major bullion banks held 212 million ounces in net short positions as of December. Those banks were betting silver would fall, and when it rallied to $122 per ounce, their losses threatened solvency. The $17 billion Fed bailout and doubled margin requirements gave them tools to escape by crashing paper prices while physical markets completely disconnected. This wasn't a one-time event. The pattern matches previous manipulations regulators have already prosecuted and proven in court. The mechanics are identical. The timing is suspicious. The paper-physical disconnect is unprecedented. While regular investors lost 40% overnight, sophisticated players with inside knowledge positioned to profit from chaos. The real question isn't whether manipulation occurred. The evidence makes that clear. The question is what happens next when the paper system can no longer suppress physical reality, and whether this 17% bounce is your last chance to position before the door locks forever. The $19 billion freeze at JieWoRui just escalated from isolated platform failure to systemic contagion event. This morning, data from the Shanghai Gold Exchange reveals physical premiums have exploded to $32 over the COMEX paper price. Let me spell out what this means for your investment decisions. While New York exchanges print a rebound to $84 per ounce on your screen, the East is actually valuing and transacting silver at over $116 per ounce. That's not a premium. That's a completely separate price discovery mechanism operating in parallel to our paper markets. This confirms everything Kiyosaki warned about when he called this a mega sale rather than a collapse. The physical metal people can actually hold in their hands is worth 38% more than the paper contracts trading in New York and Chicago. Think about the implications. If you buy paper silver at $84, believing you got the bounce, but physical silver trades at $116 in the world's largest consumer market, you don't own silver. You own a promise from a bank that might not have any metal to deliver. But here's where the story gets explosive, and why this 17% bounce happened exactly when it did. Internal memos leaked this morning reveal JPMorgan's sudden short cover wasn't triggered by technical analysis or chart patterns. According to sources familiar with London vaulting operations, a major physical storage provider issued a force majeure warning. They cannot satisfy physical delivery requests for the March contract. Force majeure is the legal equivalent of waving a white flag. It means the infrastructure everyone assumed would function normally has broken down completely. Let's connect these dots carefully, because this is the smoking gun that proves criminal manipulation rather than market forces. JPMorgan receives warning that London vaults can't deliver physical silver for March contracts. Within hours, JPMorgan begins covering shorts aggressively, triggering the 17% bounce. The bank isn't covering because they changed their market outlook or became bullish on silver fundamentals. They're covering because they got tipped off that the paper game is about to implode when March delivery demands exceed physical availability. This is textbook front-running based on material non-public information. And we have hard proof this bank has done exactly this before, because JPMorgan paid $920 million in 2020 for silver spoofing that occurred from 2008 through 2016. That's not ancient history. That's the same decade, the same markets, the same manipulation playbook. 2 of their traders went to federal prison. The Justice Department proved in court that JPMorgan systematically placed fake orders to manipulate silver prices, then canceled those orders and traded in the opposite direction for profit. Here's what makes the current situation even more brazen. While JPMorgan was paying that $920 million fine for past manipulation, they were simultaneously accumulating 750 million ounces of physical silver. Let that sink in. The bank got caught manipulating prices downward through illegal spoofing, paid the fine, then used those artificially suppressed prices to buy massive amounts of the physical metal they had just manipulated lower. And now, in January 2026, JPMorgan is taking record delivery from COMEX warehouses, while retail investors panic over the 17% bounce, wondering if they should sell. This isn't conspiracy theory. This is documented pattern backed by court records, regulatory fines, and publicly available COMEX data. The question every American needs to ask is simple. If JPMorgan manipulated silver for 8 years, got caught and fined, then immediately resumed accumulating physical metal, why would we assume they stopped manipulating? The evidence suggests they refined their techniques and continued the exact same strategy with one key difference. This time, the physical shortage is so severe they're getting caught in their own trap. Today's CME Stocks at Register report confirms the mathematical impossibility of the current system. Eligible silver inventory in COMEX warehouses has plummeted to 29 million ounces. That's a record low. But here's the devastating calculation. The total open interest in silver futures contracts represents obligations to deliver physical metal that exceeds available inventory by a ratio of 410 to 1. Write that again. 410 ounces of paper obligations for every 1 ounce of deliverable physical silver. This ratio is mathematically impossible to resolve without either massive price increases or systemic default. When March contracts come due, someone holding paper promises will discover there's no metal to deliver. The Force Majeure warning from London vaulting providers is the first crack in the dam. Banks knew this was coming, which explains why that unnamed institution needed $17 billion in emergency Fed funds. They were facing margin calls and delivery obligations on short positions with no physical metal available to satisfy those obligations. The inventory drawdown tells the story of desperation. According to COMEX vault reports, eligible silver dropped 60% in 4 days during the December crash. Think about that timeline. While they were crashing paper prices through margin requirement increases, physical metal was hemorrhaging out of warehouses at the fastest rate in exchange history. Someone was standing for delivery while paper prices collapsed, extracting real metal at artificially cheap prices while retail investors were being shaken out. Shanghai premiums validate this split between paper manipulation and physical reality. After spiking to 95% during the initial panic, premiums have stabilized at 22% above London spot prices. That's not normal market friction or temporary dislocations. That's a permanent repricing of physical silver in the world's largest consumption market. Chinese buyers have decided COMEX prices are irrelevant fiction, and they'll pay whatever necessary to secure actual metal. The backwardation data confirms supply stress that should terrify any bank holding short positions. Silver has remained in backwardation for 6 consecutive months. For those unfamiliar with commodity market structure, backwardation means near-term contracts trade at higher prices than future contracts. This signals immediate shortage and delivery concerns. Normal commodity markets trade in contango, where future prices exceed spot prices due to storage and carrying costs. Sustained backwardation screams that physical metal is so scarce that market participants will pay premium prices for immediate delivery rather than wait. Banks used Kevin Warsh's nomination announcement as perfect cover to execute their manipulation playbook. Within hours of that news breaking, trading volumes exploded with obvious wash trading signatures. According to analysis from commodity trading firms monitoring exchange data, block trades executed in milliseconds with identical bid-ask characteristics suggest algorithm-driven spoofing identical to the patterns JPMorgan was prosecuted for previously. They dumped paper contracts in massive coordinated waves during low liquidity Asian hours, knowing this would trigger stop-loss orders and forced liquidation from retail and institutional investors. The derivative unwinding confirms coordination between paper silver manipulation and exchange-traded products. SLV and AGQ, the 2 largest silver ETFs, experienced record outflows during the crash despite physical silver premiums spiking globally. How do investors redeem ETF shares at the same time physical buyers are scrambling for metal? The answer is that institutional players were unwinding paper exposure while simultaneously acquiring physical metal at the artificially depressed prices their own selling created. It's the same playbook. Manipulate paper prices downward, triggering retail panic and ETF redemptions, then use those cheap prices to accumulate the physical metal you'll need when the paper system breaks. This pattern is identical to 2008 manipulation that regulators already prosecuted. During the financial crisis, JPMorgan used the chaos of Lehman Brothers' collapse to manipulate precious metals while accumulating physical positions. The Justice Department obtained internal communications proving traders knew they were manipulating prices through illegal spoofing. It's the same bank, the same market, the same techniques. The only difference now is the physical shortage is so acute that their manipulation window is closing. When you can only push paper prices down while physical premiums explode to 95%, the divergence becomes too obvious to hide. Federal prosecutors sent 2 JPMorgan traders to prison for this exact conduct. Michael Nowak, head of precious metals trading, and Greg Smith, senior trader, both received multi-year sentences for spoofing gold and silver markets. The evidence showed they placed thousands of fake orders designed to trick other market participants, then canceled those orders and traded in the opposite direction for profit. That conviction was 2020. We're now in 2026 and watching identical trading patterns during this December crash and January bounce. The mathematics make the outcome inevitable. With 410 ounces of paper obligations for every ounce of physical silver in COMEX warehouses, with London vaulting providers issuing force majeure warnings with Shanghai premiums at $116, while New York prints $84, something has to break. Either paper prices explode upward to ration scarce physical supply, or the futures market defaults on delivery obligations and the entire pricing mechanism collapses. JPMorgan taking record. January delivery while covering shorts during this 17% bounce proves they are positioning for the break. They know the March contract expiration will expose the shortage. They know force majeure is spreading through the London vaulting system. They know the 410-to-1 leverage is mathematically impossible to maintain. So they're covering shorts now, claiming physical metal from COMEX warehouses and letting retail investors debate whether $84 represents a good entry point while the physical metal they're actually acquiring trades at $116 in Shanghai. This is the proof the manipulation thesis isn't theory. It's documented criminal conduct that courts have already validated. It's mathematical impossibility in warehouse inventory ratios. It's force majeure warnings from the physical delivery infrastructure. It's the same bank that paid $920 million for past manipulation, now positioning for the paper system break they helped engineer. The question isn't whether this is manipulation. The question is whether you understand what happens next when 410-to-1 leverage meets physical shortage, and whether this 17% bounce is your last warning to position before that collision occurs. Let's run the math that banks are desperately hoping you won't calculate yourself. That 410-to-1 paper-to-physical ratio is not just a temporary imbalance that will resolve through normal market forces. It's a mathematical guarantee that the $84 rebound you're seeing is merely the starting line for a total systemic reset. Here's why this number should terrify anyone holding short positions or paper promises instead of physical metal. March 27th marks first notice day for COMEX silver contracts. This is the date when holders of futures contracts can demand physical delivery. According to open interest data, 528 million ounces of promised delivery must collide with vaults containing less than 29 million ounces of registered metal available for delivery. Think about what happens when someone shows up at a bank with 528 withdrawal slips, but the vault only contains $29 in cash. The bank doesn't tell customers to wait patiently. The bank closes its doors, declares force majeure, and the currency collapses. This creates what I'm calling the Kiyosaki paradox. Kevin Warsh talks about monetary stability and hints at commodity-backed frameworks while our country carries $36 trillion in debt. Robert Kiyosaki calls this crash a mega sale because he understands that the current paper price of silver is a mathematical lie that will be corrected violently when reality overwhelms manipulation. The paradox is simple. You cannot have monetary stability backed by commodities when the paper price of those commodities is suppressed 410-to-1 below physical availability. The $36 trillion debt makes this paradox explosive rather than theoretical. If Warsh actually implements any form of commodity backing for the dollar, the government needs massive quantities of gold and silver to provide that backing. But the suppressed paper prices have created a situation where available physical metal has already been claimed by those who understood the game. China accumulated, Russia accumulated, JPMorgan accumulated 750 million ounces. Central banks worldwide increased gold reserves by record amounts. The metal that would provide monetary stability has already been transferred from weak hands to strong hands at artificially cheap prices. This is why Shanghai's $116 physical floor matters more than COMEX's $84 paper price. The Chinese market is telling you what silver actually costs when you need to take physical possession rather than trade paper contracts. As the JieWoRui $19 billion freeze spreads to Western platforms, that Shanghai price becomes the global benchmark because it's the only price where actual metal changes hands. Paper markets can print any number they want on screens. But when delivery time comes, physical scarcity sets the real price. Let me show you the fundamental mispricing that makes the current situation unsustainable. The gold to silver ratio currently sits at 57-to-1. That means it takes 57 ounces of silver to buy 1 ounce of gold. But look at the actual scarcity ratios that should determine relative pricing. Silver and gold come out of the ground at a mining ratio of 8-to-1. For every ounce of gold mined, 8 ounces of silver are mined. Yet silver trades at 57 times less than gold, despite being only 8 times more abundant at the source. The vault ratios make the mispricing even more obvious. According to London Bullion Market Association data, allocated gold and silver in vaults trade at a ratio of 3 to 1. There's 3 times more silver in vaults than gold, yet the price ratio is 57 to 1. The above-ground available supply ratio is nearly 1 to 1 when you account for the fact that most silver gets consumed in industrial applications, while gold gets hoarded. Silver disappears into solar panels, electronics, medical devices, and automotive components. Gold sits in vaults. Yet the metal that's being consumed and depleted trades at a fraction of the price of the metal that accumulates. These ratios reveal the mathematical target for silver's inevitable repricing. At current gold prices, around $4,800 per ounce, matching just the mining ratio of 8 to 1 would put silver at $600 per ounce, matching the vault ratio of 3 to 1 projects, $1,600 per ounce. Even using the conservative approach of matching above-ground availability at 1 to 1 suggests $4,800 per ounce for silver. This is why Kiyosaki's $200 target isn't optimistic speculation. It's actually conservative compared to what fundamental scarcity ratios indicate. My analysis using the most conservative vault ratio puts the minimum fair value range at $260 to $350 per ounce. This accounts for industrial consumption, the cumulative deficit in physical markets, and the leverage ratios that must unwind. Anything below $260 represents silver trading at a discount to its fundamental scarcity even before you factor in monetary demand or investment flows. Speaking of that cumulative deficit, the supply shortage isn't new or temporary. According to Silver Institute data compiled from global mining production and industrial demand, silver markets have run an 820 million ounce cumulative deficit from 2021 through 2025. That's 820 million ounces more demand than new supply over 5 years. This deficit had to be met by drawing down existing inventories, which explains why COMEX warehouses are now at record lows, and why Shanghai premiums exploded when China's export ban cut off one source of that inventory. The deficit is accelerating in 2026 as structural shortages worsen. Solar panel production is expanding globally as countries chase renewable energy targets. Electric vehicle production is ramping up, with each EV containing approximately 1 ounce of silver in electrical components. AI data centers require massive amounts of silver in servers and cooling systems. None of these industrial demands are price sensitive. A solar panel manufacturer does not stop production because silver hits $100 per ounce instead of $80. They pay whatever necessary to keep assembly lines running. This creates the squeeze mathematics that should keep banks awake at night. Those shorts need to deliver physical silver against backwardated contracts, where immediate delivery commands premium prices over future delivery. March through May 2026 is when the March contracts expire and delivery demands peak. Based on current open interest and available registered inventory, the paper system mathematically breaks during this window. There simply isn't enough physical metal to satisfy all delivery requests at current prices. The historical pattern from previous squeezes shows what happens when physical overwhelms paper. The Hunt Brothers Silver Corner in 1980 saw prices spike from $6 to $50 per ounce in a matter of months. That's a 700% move in under a year. The 2011 silver squeeze pushed prices from $18 to $48 in 8 months, a 260% gain. Both examples showed 300 to 400% vertical moves occurring over 60 to 90-day windows once the physical shortage became undeniable. We're seeing the exact same setup forming now. Singapore bullion dealers have queues. China sold out at 95% premiums. The US Mint depleted Type 2 Silver Eagle blanks. London vaulting providers issued Force Majeure warnings. The infrastructure that is supposed to deliver physical metal is breaking down while paper prices claim everything is fine at $84. History shows that when this divergence reaches critical mass, the price adjustment happens violently over a very compressed time frame. Current setup math projects the spike range based on historical precedent and fundamental scarcity, starting from the $78 level where silver bounced before the 17% recovery. A 300% move projects to $234 per ounce. A 400% move projects to $312 per ounce. These aren't wild speculations. These are the historical ranges that occurred during previous physical shortages, and the current shortage is more severe than either 1980 or 2011 due to the accumulated deficit and industrial demand that didn't exist in those earlier periods. This is why Kiyosaki's Walmart sale analogy resonates. He's telling people that the current suppressed prices represent a temporary window before physical reality forces repricing. But that window has a definitive closing date, and it's approaching fast. Based on the March 27th first notice day and the historical 60 to 90-day squeeze timeline, Kiyosaki's warning that the sale window closes by end of February 2026 isn't marketing hype. It's mathematical calculation of when the March contract crunch triggers the repricing cascade. Here's what should concern every American watching this unfold. The JieWoRui $19 billion freeze is already spreading beyond China's borders. Reports are surfacing of Western platforms experiencing unusual delays in physical delivery. Some dealers have quietly stopped accepting new orders for certain products. Others are extending delivery windows from days to weeks to months. This is the early stage of contagion that precedes the systemic break. When platforms can't source physical metal to back their paper obligations, they freeze withdrawals just like JieWoRui did. First, it's a Chinese platform. Then it's a Singapore dealer. Then it's a European bank. Then it's a major Western exchange. The window to own physical ounces, or verified digital silver backed by allocated metal, is closing before the market switches to no offer status. This is the critical point investors need to understand. No offer doesn't mean high prices. It means silver is no longer available for purchase at any paper price, because sellers refuse to part with physical metal for currency that is losing credibility. We've seen this before in Venezuela, in Zimbabwe, in Weimar Germany. When hyperinflation or currency crisis hits, commodities disappear from markets regardless of the nominal price offered. Digital platforms offering allocated silver like Cadvan provide one alternative for investors who understand the physical shortage, but can't securely store large quantities of metal. The key distinction is allocated versus unallocated. Allocated means specific bars with serial numbers assigned to your account. Unallocated means you own a claim on a pool of metal that may not exist, exactly like the COMEX paper game. As the JieWoRui freeze demonstrated, platforms operating on fractional reserve or unallocated basis will lock customer accounts when physical demand exceeds their actual holdings. The Warsh nomination creates a timeline urgency that amplifies the March contract squeeze. If the new Fed chair actually moves toward commodity backing or sound money policies, the rush to secure physical precious metals accelerates dramatically. Every central bank, every sovereign wealth fund, every major institution will simultaneously try to acquire metals that are already in structural deficit. The $36 trillion debt means the U.S. government itself might need to acquire massive silver reserves to provide even partial backing for the dollar. Good luck buying 5 billion ounces when COMEX vaults hold 29 million and China stopped exporting. This creates the climax scenario that resolves the paradox. Either paper prices explode upward to ration scarce physical supply and reflect true scarcity ratios, or the paper markets default and physical trades in completely separate markets at whatever price clears. Either outcome means the $84 rebound is the starting line, not the finish line. The question isn't whether silver reaches $200 or $300. The question is whether it happens in 60 days or 90 days, and whether you positioned before the window closed. The banks know this. JPMorgan's record. January deliveries prove they're accumulating physical while retail investors debate chart patterns. The $17 billion Fed bailout proves regulators know banks are trapped in shorts. They can't cover at current prices. The Force Majeure warnings prove the delivery infrastructure is breaking. The 410-to-1 leverage proves the current system is mathematical fantasy. The Shanghai $116 physical price proves the market is already repricing outside the paper system. March 27th is the catalyst date when 528 million ounces of delivery demands meet 29 million ounces of available metal. Between now and then, smart money is exiting shorts, claiming physical, and positioning for the spike. The mega sale window Kiyosaki describes isn't going to last through spring. It's closing now, before first notice day, before the March squeeze, before the no-offer status spreads from Asian platforms to Western exchanges. The math is clear. The timeline is defined. The historical precedent is documented. The only question is whether you understand that this 17% bounce from $78 to $84 is the market giving you one final chance to position before the door locks, the paper system breaks, and physical silver reprices to reflect 410-to-1 leverage unwinding into 29 million ounces of available supply. That's not the end of the silver story. That's the beginning of the reset Warsh hinted at, and Kiyosaki has been warning about. The sale ends in February. The squeeze starts in March. The repricing happens in 60 to 90 days. The banks are already positioned for what comes next. Are you? Let me be direct with you. We are no longer in a normal market. We are in a liquidation of the old world. Between the $19 billion frozen in China and the 410-to-1 leverage on the COMEX, the system is begging for a reset. Robert Kiyosaki said it best. This isn't a crash. It's a sale. But the sale ends when the shelves are empty. And according to the vault reports I'm looking at right now, the shelves are already bare. JPMorgan is covering. Shanghai is paying a $32 premium. JieWoRui has locked the doors. The only question left is, Will you be holding the paper promise or the physical reality? Don't wait for $150 to decide. The truth is already here. I'll see you in the next one.